Have you ever wondered how to build a single stock portfolio? If so, you're in the right place. Building a single stock portfolio isn't as daunting as it might seem. It begins with the right mindset. You see, investing should spark curiosity, engaging you with your finances and the markets. It's about more than just making money. It's about understanding how the market works, how money grows, and how you can use this knowledge to achieve your goals. Diligence and persistent focus are also key. They help boost your returns and mitigate risks. But it's not just about being diligent. It's about enjoying the process, taking pleasure in the research and the decision-making. It's about finding joy in the journey, not just the destination. And then there's the question of volatility. Markets will fluctuate, and that's a given. But with the right mindset, you can ride out the storms without letting your emotions lead you to make rash decisions. So how exactly should an individual investor approach building a portfolio? Let's find out. You might be wondering how to get started with building your portfolio. Let's consider a scenario. Picture this. You have $100,000 at your disposal. Now, you could pour all of this into one venture, but that's a bit like putting all your eggs in one basket. It's risky, and it's not the recommended strategy. Instead, let's consider a more measured approach. Imagine dividing this sum, allocating a portion to individual stocks you've personally picked, and the rest to core index ETFs or funds. Let's say you decide that no more than 5% of your capital should be invested in any one individual stock. So, if you choose to invest in 5 different stocks, that's $25,000 spread across 5 different companies. This approach not only allows for potential growth, but also mitigates risk. If one stock performs poorly, you have 4 others that might be doing well. This is the essence of diversification. It's about spreading your investments across a variety of stocks, sectors, and asset classes to manage risk. The remaining $75,000 of your portfolio could then be invested in core index ETFs or funds. These types of investments aim to track the performance of a specific index and can provide broad market exposure, further diversifying your portfolio. Now, the allocation percentages in this scenario are purely illustrative. The actual allocation would depend on a variety of factors like your financial goals, risk tolerance, and investment horizon. The important thing is to have a plan and stick to it. But here's the tricky part. With thousands of stocks out there, how do you choose which ones to invest in? This is where your personal interests, experience, and knowledge come into play. You'll need to do your research, of course, but investing in what you know can be a good starting point. But how do you choose which stocks to invest in? Let's delve into that next. Choosing the right stocks can seem daunting, but it doesn't have to be. The key is to consider your interests, your expertise, and invest in what you know. Let's explore this idea a bit further. Picture yourself on your favorite cruise ship, basking in the sun, feeling the sea breeze on your face. Now, what if you could turn this passion for travel into a financial gain? You're already familiar with the industry, you know the brands, the services they offer, maybe even the business models. So why not consider investing in companies like Norwegian Cruise Lines or Royal Caribbean? Or perhaps you're more of a landlubber and your interests lie in hospitality companies like Marriott Hotels. Now let's shift gears and think about healthcare. Maybe you're a medical professional or you're closely familiar with the healthcare needs of our aging population. Companies like Dividend, a leader in renal disease and dialysis, or Dexcom, a diabetes device maker, or even Quest Diagnostics, a diagnostic lab company, could be potential investment opportunities. These companies have a strong foothold in their respective areas and cater to a growing and recurring clientele, making them worthy of consideration. What if you're tech-savvy and have a good understanding of corporate environments? Companies like ServiceNow and Workday, both of which are making waves in corporate America, might catch your interest. They're growing rapidly and are integral to corporate workflow and personnel management. And of course, there's always the evergreen retail sector. We all shop, right? Companies like Costco, Walmart, and Home Depot, or even smaller players like Pepsi or Sherwin-Williams Paints might be right up your alley. The point is, investing in what you know isn't just about understanding the financials. It's about understanding the business, the industry, and the trends. It's about recognizing the value in the products and services you use every day and capitalizing on that knowledge. And just a quick pause now to say thank you to those returning subscribers and everyone sharing and liking our videos. If you haven't yet, consider giving us a subscribe to support our work. We really appreciate it. But what about other sectors? Let's explore. Diversification isn't just about spreading your investments across different stocks. It's also about ensuring you're invested across various sectors. Investing in a single sector can be risky, as you're essentially putting all your eggs in one basket. If the sector takes a hit, so does your portfolio. By diversifying across sectors, you're spreading your risk and potential for growth. Consider the retail sector as an example. It's a vast field with a myriad of investment opportunities. You could invest in a large retail giant like Walmart or Costco, known for their broad consumer base and consistent performance. Alternatively, you could opt for a niche player like Sherwin-Williams Paints, who have their own loyal customer base and unique market advantage. This sector alone offers diverse opportunities for investment. Remember, the opportunities are endless when you invest in what you know and love. So explore various sectors and choose stocks that resonate with your interests and knowledge. The final factor is how to build a position. We recommend never buying all at once, and instead starting out with just half the initial investment amount. Then, and after a few days or weeks at minimum, add to the holding with an additional quarter and then the final portion, so 3 buy points. There is no right or wrong way purse or amounts, it's an individual choice. But the key point is to stagger the purchases and build the position with the consideration that the stock could fall in price and give a better lower cost entry, and that over time, you'll make the decision to add only once the stock shows progress in price appreciation. Building a single stock portfolio isn't as complicated as it may seem. By adopting the right mindset, you can navigate market volatility and make long-term decisions that align with your financial goals. Remember, it's about engagement, fun, and personal interest. Think of it as building a relationship with your money and the market. Diversification is key. Spread your investments across different sectors and companies. Investing in what you know can provide a certain level of comfort and control. You might love cruising, have a knack for understanding medical trends, work in IT, or frequently shop at a specific retail store. These are all opportunities to invest in what you know. Don't forget the importance of investing in best-of-breed companies, those with good management and a strong market position. It's not just about picking stocks, it's about picking winners. On that note, be sure to speculate carefully and consider picking only just one stock of your 5 if the stock is not in the most recognized top 500 to 1,000 index stocks. With your insights and a little diligence, you can build a diversified portfolio and lower your risk of investing. You've got this.